silver just collapsed over 40% in less than 2 weeks. From $100 to $21 an ounce to the mid-60s, the worst crash since 1980. And every headline, every analyst, every talking head is telling you the same thing. The bull market is dead. Game over. But here's what they're not telling you. While the price was imploding on your screen, the physical metal became nearly impossible to borrow in London. Lease rates, the cost to rent actual silver, spiked to 4.5%. That's not a typo. In normal markets, that number sits at 0. So let me ask you something. If demand for silver just collapsed, if the bull market is truly over, why are the people who actually handle physical metal paying unprecedented premiums just to get their hands on it right now? Stay with me until the end, because what I'm about to show you isn't just about silver. It's about how markets teach you to confuse price with reality, and why the biggest players benefit when you believe it's over. Part 1. The illusion of a bull market collapse. Let's get the facts straight first. Silver went from roughly $121 per ounce to the mid-60s in under 2 weeks. That's a 40+% nosedive. To put that in perspective, this is the kind of violence you usually only see during systemic financial collapses. 1980 level chaos. And look, I get why everyone's spooked. But here's the thing about silver that most people forget. It's not gold. The silver market is smaller, thinner, more fragile. When money floods in, it goes parabolic. When it floods out, it craters just as fast. This isn't new. This is structural. Silver has always been the volatile little brother in the precious metals family. Now, throughout January 2026, something wild happened. Speculative capital poured into silver like a broken dam. Leveraged ETFs, call options, futures contracts stacked on futures contracts. Everyone wanted in. The rally was real, the momentum was real, but so was the fragility underneath it all. Let me introduce you to a concept that's going to matter a lot in this story. Paper silver versus physical silver. Paper silver is what trades on exchanges like COMEX in New York. It's contracts, promises, bets on future prices. Physical silver is the actual metal sitting in vaults, moving through refineries, getting fabricated into solar panels and circuit boards. These two things are supposed to track each other, but they don't always. And when they diverge, that's when things get interesting. The January rally was built almost entirely on paper. Traders weren't buying bars of silver and stacking them in their basements. They were buying contracts with borrowed money, betting that the price would keep climbing. This creates what I call the bullish leverage chain. Every dollar that goes up attracts more buyers, which pushes the price higher, which attracts even more buyers. It's a beautiful, fragile feedback loop. But here's the problem. Leverage cuts both ways. When the chain is pulling you up, it feels like genius. When it reverses, it's a guillotine. And the people riding this wave in January weren't long-term holders. They were speculators, adrenaline junkies, gamblers with borrowed chips. The moment volatility spiked, the moment prices started to wobble, the whole thing was set to unravel. And that's exactly what happened. The price started falling, margin calls started hitting, forced liquidations began, and suddenly, the same mechanism that drove silver to $121 became the mechanism that dragged it back down to $65. It wasn't a collapse in demand for silver as a metal. It was a collapse in the ability of over-leveraged traders to hold their positions. But here's where most people get it wrong. They look at the price chart, see a 40% drop and conclude, well, the bull market is over. Supply must be flooding in. Demand must be dead. That's the narrative. That's what the price action seems to scream at you. And if you stop there, if you don't dig deeper, you'll miss what's actually happening. Because price, my friends, does not equal supply and demand truth, especially not in a leveraged futures market where 95% of the participants never touch physical metal. Price in these markets reflects the balance of leveraged bets, not the physical reality of metal moving from mines to manufacturers. And when leverage collapses, price collapses, even if the underlying fundamentals haven't changed at all. So everyone's conclusion? The bull market is over. Silver's done. Time to move on. That's the story they want you to believe. But that conclusion collapses the moment you audit how this market actually works. Part 2, the leverage trap, how 5 cents controlled a dollar. Let's talk about the mechanics, because this is where it gets forensic. On COMEX, the futures exchange where most silver trading happens, you don't need to put up the full value of your position. You only need to post margin, a fraction of the total. And during the January rally, that fraction was tiny. Some traders were controlling a full silver position with only 5 cents of their own capital and 95 cents borrowed. That's roughly 19 times leverage. 19 to 1. Think about what that means. If silver moves against you by just 5%, your entire equity is wiped out. You don't lose some money, you lose everything, and then you owe more. This isn't a moral judgment. This is just math. And the math is brutal. When volatility rises, when prices start whipping around, these positions become radioactive. You can't hold them. The exchange won't let you. Margin requirements go up, and suddenly you're forced to either inject more cash, which most traders don't have, or liquidate. Sell now, ask questions later. Now here's where it gets mechanical, not conspiratorial. Exchanges like CME Group, which runs COMEX, have a job: manage systemic risk. When they see volatility spiking, when they see a market getting dangerously over-leveraged, they raise margin requirements. This isn't manipulation. This is standard operating procedure. It happens in every commodity market in both directions. It's designed to protect the system from blowing up. But for traders riding 19 to 1 leverage, a margin hike is a death sentence. And in the case of silver, the CME didn't just raise margins once. They raised them 6 times in a single month. Let me walk you through it. It started in mid-December 2025. The CME began hiking margins gradually, first from $22,000 to $24,200, then to $25,000. These were fixed dollar amounts, manageable if you had cash. But then, on December 31st, they cranked it to $32,500. That's a big jump. Traders started feeling the squeeze. Then, in early 2026, they switched tactics. Instead of fixed dollar amounts, they moved to percentage-based margin requirements. On January 28th, they raised the initial margin from 9% to 11%. High-risk accounts went to 12.1%. Just 3 days later, they hiked it again to 15%, with high-risk accounts at 16.5%. And then, on February 5th, they pushed it to 18%. Now let me explain what this does to someone operating at 19 to 1 leverage. When the margin requirement was 5%, you could control a $100,000 position with $5,000. Tight, but doable. But when that requirement jumps to 8%, suddenly you need $8,000. If you don't have that extra $3,000 sitting around, you're forced to sell. And when hundreds, maybe thousands of traders are all forced to sell at the same time, the price doesn't just drop, it craters. And here's the kicker. Falling prices trigger more margin calls. Trader A gets liquidated, pushes the price down 2%, which triggers Trader B's margin call, who then liquidates, pushing the price down another 2%, which triggers Trader C. It's a cascade, a mechanical flush. And it has nothing to do with whether solar panel manufacturers still need silver or whether industrial demand is weakening. It's just math eating itself. The exchanges know this. The CME knows this. That's why they raise margins, to force out the reckless cowboys before the whole system implodes. And I use that term, reckless cowboys, not as an insult, but as a structural descriptor. These are the participants who took on absurd leverage, who are always going to blow up the moment volatility spiked. They're not evil, they're just fragile, and in a volatility storm, fragile doesn't survive. So the big question is, if this was truly a demand collapse, if silver's fundamentals had actually broken, the physical market should confirm it. Right? Prices should be falling everywhere. Physical dealers should be sitting on inventory they can't move. Lease rates should be dropping because no one wants to borrow metal, but that's not what's happening, not even close. Part 3. Paper crashes, physical panics. Let's go to London. Not the tourist spots, not Buckingham Palace. Let's go to the London bullion market, the nerve centre of the global physical silver trade. This is where the real metal changes hands, where refiners, mints, industrial users, and banks actually borrow and lend physical silver to manage their supply chains. In a normal market, when you want to borrow silver for a short period, say 1 month, you pay a lease rate. That rate is usually around 0%. Sometimes slightly positive if the lender wants to earn a bit, sometimes slightly negative if there's too much metal sitting around. Anything above 1% is already a red flag. It means the physical market is tight. People need metal now, and there's not enough to go around easily. Right now, as the paper price is collapsing, lease rates in London are sitting between 4.5 and 6%. Let me say that again, 4.5 to 6%. That is extreme. That is screaming physical shortage. In 2023 and 2024, lease rates hovered around zero, stable, boring, plenty of metal. But in early 2026, during the very weeks that silver's price is imploding, the cost to borrow physical metal has gone parabolic. Why? Because the people who actually need silver, mints producing coins, manufacturers building electronics, industrial users fabricating solar panels, they can't wait for the futures market to sort itself out. They need metal now, and when everyone needs metal now, and there's not enough immediately available, the price to borrow it spikes. This brings us to a concept called backwardation. In a normal commodity market, the price for future delivery is higher than the price for immediate delivery. That's called contango. Why? Because there's a cost to holding a physical commodity. You have to pay for storage, insurance, security. You tie up capital. All of that gets priced into the forward curve. So if silver costs $70 today, a contract for delivery in 1 year might cost $72. That extra $2 reflects the cost of carry. It's normal. It's boring. But when a market goes into backwardation, that flips. The price for immediate delivery is higher than the price for future delivery. That's weird for a storable commodity like silver. It means people are willing to pay a premium to get the metal right now, even though it's more expensive than waiting. It's a signal of urgency, of shortage, of stress in the physical market. And right now, silver is in extreme backwardation. The 1-year silver swap rate minus US interest rates has dropped deep below zero. In plain English, that means, I don't care what the paper price says. I don't care what COMEX futures are trading at. I need physical silver and I need it now, and I'm willing to pay extra to get it. Let me put this in perspective. When you see backwardation in oil, it usually means there's a refinery fire, or a war, or a supply chain breakdown, something acute. For silver, it's happening while the paper price is crashing. That divergence is telling you something. It's telling you that the price you see on the screen is not reflecting physical reality. And it's not just London. Let's look at the actual metal itself, where it's stored, who controls it, and what's happening to those stockpiles. Part 4. The disappearing silver. Inventories don't lie. COMEX, the big futures exchange in New York, doesn't just trade paper contracts. It also holds physical silver in registered vaults. This is the metal that can be delivered against futures contracts. It's the backstop, the proof that the paper market has some connection to reality. And right now, that stockpile is shrinking. Registered COMEX silver inventories have fallen to somewhere between 103 and 113 million ounces. Now let me give you some context. The total open interest for just the March 2026 contract, meaning the total amount of silver that traders are holding contracts for, represents about 528 million ounces. That's nearly 5 times the available physical stock. Does that mean COMEX is going to default? Not necessarily. Most futures contracts don't result in physical delivery. Traders roll them forward or cash settle. But it does mean that if even a fraction of those contract holders decide they want actual metal, there's not enough to go around. And that creates pressure. Real pressure. Now let's hop over to Shanghai. The Shanghai Futures Exchange is the other major hub for physical silver trading, and their inventories are collapsing even faster. On February 6, 2026, Shanghai silver stocks dropped from 412 tons to 349 tons in a single day. That's a massive one-day drain. And this isn't a blip. Shanghai's current inventories are near decade-low levels. Back in 2021, they were sitting on over 3,000 tons. Now, a fraction of that. The metal is leaving the warehouses and not coming back. Why? 2 reasons. First, industrial demand in China is insatiable. They're building solar panels, electronics, EVs, all of which need silver. Second, and this is the big one, China has decided that silver is a strategic resource, and they're not letting it leave the country anymore. Effective January 1st, 2026, China implemented a new licensing system for silver exports. You can't just ship silver out of China anymore. You need a permit. You need to prove you have an 80-ton annual production capacity. You need a $30 million credit line. These aren't bureaucratic hoops. These are walls. Beijing is treating silver the way they treat rare earth metals, as a geopolitical weapon. And it's not just China. In November 2025, the US Geological Survey added silver to the critical minerals list. That's the same list that includes lithium, cobalt, and rare earths, materials deemed essential for national security, energy independence, and advanced manufacturing. The US doesn't do this lightly. They're signaling that silver isn't just a shiny metal, it's strategic infrastructure. Here's the global picture. The world is running a deficit of 230 million ounces of silver per year. That's the 5th consecutive year of undersupply. Demand is outstripping supply and it's not even close. And here's the kicker. You can't just turn on more silver production. Unlike gold, which is mined primarily for gold, most silver is a byproduct of copper and zinc mining. That means higher silver prices don't automatically lead to more silver. You'd need to mine more copper, which depends on totally different market dynamics. So even if silver hits $200 an ounce, it doesn't mean miners will flood the market with new supply. The supply response is slow, structural, and limited. So let's recap. Inventories are falling in both the US and China. Both countries have reclassified silver as a strategic asset. The global market is in deficit. Physical lease rates are spiking. The market is in extreme backwardation. And yet, the paper price just crashed 40%. Does that make sense? Or does it tell you that the price you're seeing is disconnected from physical reality? Part 5. The $70 line, where forced selling dies. Let's talk about what happens next. Because even though the price crashed, something important happened during that crash. The weak hands got flushed out. The over-leveraged speculators, the reckless cowboys, the traders riding 19-to-1 margin, they're gone. The data shows it. Outstanding COMEX silver contracts dropped from a peak of 176,000 contracts to 137,000. That's a huge decline in open interest, and in this context, that's bullish. Why? Because it means the speculative froth is gone. The people left holding silver now are the ones who can actually afford to hold it. They're not leveraged to the hilt. They're not going to panic sell at the first sign of volatility. This is what I mean by stronger hands. The market has been reset. The leverage that amplified the crash is now mostly gone. And without that leverage, the main mechanism that could force prices lower, margin-driven liquidations, has been exhausted. Now, let's talk about the $70 level. A lot of traders sold out around $50. Why? Because 50 was the psychological peak in 1980, and again in 2011. It's a number that lives in the collective memory of the silver market. Traders who exited at 50 locked in serious profits. And here's the thing. If silver now forms a higher low, say, around 70 or 75, a lot of those same traders are going to step back in. They'll see it as confirmation that this isn't a repeat of the past crashes. They'll see it as the setup for the next leg higher. The structure of the market has changed. The excessive leverage that drove the forced selling is gone. That removes the main downward pressure. At the same time, physical demand is still exceeding supply. Inventories are still falling. Lease rates are still elevated. The physical market is still in backwardation. So the fundamental tightness that should support higher prices, it's still there. It didn't go anywhere. That combination, cleared leverage on the paper side, persistent tightness on the physical side, makes the area around $70 a realistic floor under current conditions. Not a guarantee, markets are never guarantees, but a probabilistic floor, a level where the risk-reward starts to tilt heavily in favor of the bulls. And here's where it gets interesting for investors. Silver mining stocks. These companies are still trading like silver is going back to $50. Their valuations assume that every parabolic move ends in a crash with no sustained recovery. But if 70 becomes the new floor, if the market is actually in a structural reset rather than a collapse, then mining stocks are massively mispriced. Professional investors are starting to notice. Over the past week, some have been reducing physical silver holdings and rotating into mining stocks. Why? Because if you believe silver is going higher from here, mining stocks give you leveraged exposure. A 10% move in silver might translate to a 30 or 40% move in a well-run mining company. The math is compelling. Meanwhile, even as the price crashed, the iShares Silver Trust, the big silver ETF, saw its largest weekly inflow since 2021. 724 tons of physical silver flowed into that fund. People were buying the dip, not selling in panic, buying. That tells you something about who's left in this market. But here's the thing I want to make clear. Conviction alone isn't enough. Markets don't care about your thesis. They don't care about your confidence. What matters is what the data says. And right now, the data says the physical market is tight. Lease rates are elevated, inventories are falling, backwardation is extreme. Those are the signals to watch. If lease rates fall back to zero, if backwardation turns back into contango, if inventories at COMEX and Shanghai start rising meaningfully, then the physical tightness is easing. At that point, you take profits. You reassess. You don't marry the trade. But right now, none of those things are happening. The data is still pointing in the opposite direction. Part 6. The human cost of a paper reset. Now let's zoom out, because this isn't just about traders and speculators and people staring at charts. Silver isn't just a financial asset. It's a critical industrial input. And when the price goes haywire, when volatility spikes, when supply chains get disrupted, real people feel it. Silver is in your phone, it's in your laptop, it's in the solar panels on your roof, the circuit boards in your car, the medical equipment in hospitals, the servers running AI models. It's everywhere. And the industries that rely on it don't have the luxury of sitting on the sidelines waiting for the market to calm down. They need metal now, at predictable prices, in reliable quantities. When the paper price crashes 40% in 2 weeks, but physical lease rates spike to 6%, manufacturers are caught in a nightmare. Do they lock in supply at elevated physical premiums? Do they wait and hope the paper price stabilizes? Do they try to substitute with other materials, even if it means re-engineering their entire production process? These aren't abstract questions. These are decisions that affect production schedules, employment, capital allocation. And here's the cruel irony. The volatility that hurts manufacturers the most doesn't come from changes in physical supply and demand. It comes from the leverage games happening in the futures market. The reckless cowboys blowing up their accounts, the margin hikes, the forced liquidations. None of that has anything to do with whether the world needs more silver for solar panels, but it creates chaos anyway. This is why regulators step in. This is why the CME raises margins, not to protect traders, to protect the system, to prevent a feedback loop where financial volatility spills over into the real economy. And yes, that means some traders get wiped out. That's the cost of clearing the leverage. But from a systemic perspective, it's better to purge the leverage now than to let it build until the whole market collapses. Now let's talk about the energy transition, because this is where silver's role becomes even more critical. Solar panels require silver paste for conductivity. There's no good substitute yet. Electric vehicles need silver for battery connections and electronics. AI data centers need silver for high-speed circuit boards. The very industries that are supposed to drive the next phase of global economic growth are deeply dependent on a stable, affordable supply of silver. But here's the problem. The world is running a 230 million ounce deficit every year. Supply is constrained because most silver is a byproduct of copper mining, and you can't just dial up copper production overnight. Demand is growing because of the energy transition. And now, on top of that, you have two of the world's largest economies, China and the US, treating silver as a strategic asset and restricting exports. What does that lead to? Potentially rationing, prioritization, scenarios where governments decide which industries get access to silver and which don't, defense contractors before consumer electronics, solar panel manufacturers before jewelry makers. This isn't science fiction. This is what happens when a critical material becomes scarce and geopolitically contested. And let's not forget the human element. Mining communities, refinery workers, the people who extract, process, and move this metal around the world. When prices spike, when supply chains break, when companies go bankrupt because they can't secure material, those people lose their jobs. Their livelihoods disappear. The financial markets treat this as volatility. For them, it's survival. So when I say this was a purge, not a failure, I mean it structurally. The leverage had to be cleared. The reckless cowboys had to be flushed out. The system needed a reset. But let's not pretend it was painless. It wasn't. People lost fortunes. Companies scrambled, supply chains strained. That's the human cost of a paper reset. Here's the final piece. They want you to think it's over. The headlines, the analysts, the talking heads, they all benefit when you believe the story is finished. Why? Because panic benefits the system when leverage must be cleared. Fear keeps retail investors on the sidelines. Doubt keeps you from asking the hard questions. And confusion keeps you from noticing the divergence between paper prices and physical reality. But if you've stayed with me this far, you know better. You know that the price collapse was mechanical, not fundamental. You know that the physical market is screaming shortage even as the paper market crashed. You know that inventories are vanishing, lease rates are spiking, and both China and the US have reclassified silver as strategic. You know that the leverage flush removed the main mechanism for further downside. And you know that the $70 level represents a structural reset, not the end of the bull market. This isn't over. This is the reset before the next leg higher. And the people who understand that, who see through the noise, who read the data instead of the headlines, they're the ones who'll be positioned when the real move begins.